Hi folks, David Waring here again with InformedTrades.com and the next video in a series on Trading the Economic Crisis by Sumit Patel. In the last video in this series, we continued our discussion on potential trading opportunities in the economic crisis with a look at gold. In today's video, we're going to continue this discussion with a look at an instrument which may rise in value under the deflation scenario and fall in value under the inflation scenario with a look at U.S. Treasuries. So let's get started.
Okay, in this video we're going to talk about U.S. Treasury bonds and how they can be used to preserve and grow your wealth in this economic crisis. Let's start with defining what a Treasury bond is. Basically, it's the U.S. government's version of a credit card, U.S. Federal government. What happens is the government will issue Treasury bonds, and whoever buys them is essentially loaning the government money, and the government will pay it back over time with interest. So it's basically just like the way a credit card works. You know, the credit card companies will give you a credit card, and you pay it back with interest. This is the same thing with a Treasury bond. Except the government's the one who's borrowing and you're the one that's lending. The appeal of Treasury bonds is that they're generally regarded as risk-free investments. And the reason for this is that the U.S. government can always, either through raising taxes or through printing money, make sure that you're going to get your money back. So in that sense, Treasury bonds are risk-free. Okay, in our previous videos we talked about the issue of inflation versus deflation. Deflation is characterized by when unemployment's rising and asset prices are falling, gas prices are falling, stock market's falling, that type of environment. In the second half of 2008, we saw an environment that was very deflationary. And what's going on in deflation is basically the market is avoiding risk and is going to risk-free assets, which naturally U.S. Treasury bonds is the kind of asset that will do well in a deflationary environment. So what we saw with U.S. Treasury bonds in the second half of 2008 is that the price of them went up significantly, and you can see that on the chart on the screen now. When the price of the Treasury bonds goes up, that means that the yield is going down. That means that the interest rates, the return that individuals are willing to accept on Treasury bonds is low. So basically they're just looking for something safe. The interest rate they'll accept, it doesn't have to be that great. They just want to make sure that their money is safe, and they'll take a lower interest rate. Now this year, so far in 2009, we've actually seen that trend reverse a good bit, and we've seen Treasury prices fall significantly. This would suggest that investors now want a higher rate of return. They're not accepting the lower interest rates that they were accepting in the second half of 2008. Now, one interpretation of this is that they're concerned about inflation risk, or the risk of the currencies being devalued. So basically, if you think that the U.S. dollar is going to lose a significant amount of its purchasing power, meaning prices are going to rise by the time you get your Treasury bonds back, then you're going to want a higher return, a higher interest rate, to compensate for that currency devaluation. So that's one potential reason why Treasury bonds have been falling in price, and why the yield, so to speak, has been rising on Treasury bonds in this so far in 2009, as it could reflect concerns over currency devaluation. So this is an example of how the issue of inflation and deflation can be a key part of your strategy, and depending on how you view things, will affect whether you want to buy Treasuries or at what rate you want to buy Treasuries. Okay, also related to this in terms of going forward and how we can look at things is in March of 2009, the Federal Reserve started printing money to buy Treasury bonds. Okay, so this is sort of a paradoxical, or it has counteracting effects, in the sense that printing money runs the risk of devaluing the currency, which is bad for Treasuries and causes those who are buying Treasuries to demand a higher rate of return, because they have to beat the rate of inflation, or the rate that the currency is being devalued. But at the same time, since the Federal Reserve is printing money to buy Treasuries, that will actually increase demand for treasuries, increase the price of treasuries, and push the yield down. So it sort of works, it sort of negates itself. But it is something to consider. Now, in my personal opinion, it's a detrimental sign for the U.S. dollar and the solvency of the Federal Reserve that they're printing money to buy treasuries. So, in my opinion, I would be leaning more towards the inflation side of things and concerned about treasuries from an inflation side and how the dollar could be really devalued if I bought treasuries. Also, something that's will be of importance for those who are buying treasury bonds or selling treasury bonds is that China, who is one of the largest holders of treasury bonds and buyers of treasury bonds, is shifting to shorter maturity terms of the treasury bonds. Meaning, often there's a 30-year bond in which the full principal that is loaned to the U.S. government will be paid back over 30 years. Now, the more concerned you are about inflation or the currency risk being an issue, the less likely you are to give out a 30-year loan, and you want a shorter loan. So China is moving towards shorter maturities, as you can see on the screen now, which is an indication that they might be concerned about the value of the dollar, and it's also important because whether or not their concerns are legitimate, if China decides to sell their treasuries or run away from their treasuries, that will impact the whole treasury market. That will send the dollar down and will send treasuries, will cause people to demand higher yields for treasuries as well after sending treasury prices down. So definitely, if you're buying or selling treasury bonds, watching China and seeing how they could possibly affect the market is something that's important. Okay, so in terms of the opportunities in the treasury market, basically it boils down to two opportunities. If you're on the inflation side of things, like I am, you view a weak dollar or the risk that the Federal Reserve will devalue the dollar as a big risk. In which case, treasuries are actually not a good investment unless you're going to get a very, very high yield. Even in that case, there may be better investments, which we'll get to in future videos. But from this perspective, it would seem that treasuries are overvalued, and you'd want to sell treasuries. On the other hand, if you think that deflation is the issue, if you think the dollar is not really in danger and that it's going to remain pretty strong or might not lose too much more value, then this could be a great opportunity to buy treasuries, especially given how much they've fallen thus far in 2009. So it's really a question of which side of the issue you're on, whether you think the dollar will stay strong or whether it's going to weaken. And that's pretty much the issue with treasury bonds. As always, if you have any questions or would like to go into greater detail on this matter, you can visit us at informtrades.com. And in future videos, we'll be discussing other assets that you can use to grow and preserve your wealth in this economic crisis. Thanks.